Okay, picture this. It's 2026. The stock market is just a blur of high-speed AI, making trades faster than you can blink. In a world like that, could a financial theory from way back in 1952, we're talking the era of black and white TV, could that actually be your secret weapon? It sounds absolutely nuts, right? But what if it is? You probably felt it, that little nagging feeling in the back of your mind that the whole game is, well, rigged. You hear about high-frequency trading, these faceless algorithms making billions, and you're just left there wondering, am I just bringing a knife to a gunfight here? Does the small individual investor even stand a chance anymore? Well, this number right here, this is the reason you feel that way. 82%. That is the probability that an algorithm will see your trade and jump in front of it if you're delayed by just 50 milliseconds. That is literally less than a blink of an eye. So no, this isn't a level playing field. It's a massive structural disadvantage, and it's just built right into the system. And here's the scale of it all. Just look at this. A tiny, tiny fraction of firms, 0.3%, control almost half of all the market orders out there. They don't just have a small advantage, they basically own the high-speed railway of modern finance. So, if we're going to have any chance of winning, first, we really have to understand the battlefield. And right now, in 2026, that battlefield is a high-speed, algorithm-driven game. And here's the hard truth, okay? If your strategy is trying to outtrade these algorithms to try and catch those little short-term swings, you're playing a game you are mathematically guaranteed to lose. The house always wins, and in this particular casino, the house is an algorithm. So if we can't possibly win on speed, where do we look for an edge? Well, the answer, and this is the surprising part, is in the past. We have to go all the way back to 1952 to a Nobel Prize-winning idea called modern portfolio theory. I know, it sounds ancient, right? How could a theory from the age of poodle skirts possibly be relevant today? At the heart of this old theory is something called the efficient frontier. Now, think of it like a menu at a restaurant. You're not just looking for the one single best dish. No, you're trying to create the perfect meal for you, the smartest combination of dishes that gives you the most enjoyment, or in this case, return for the price you're willing to pay in risk. It's about finding that mathematical sweet spot. But for decades, this theory had a really big, fatal flaw. The logic, the math, it was beautiful, it was sound, but it was like having a perfect map of the world from 1952. All of its inputs were based on historical data. It was always looking in the rearview mirror, completely blind to the road ahead. And this is where our story takes this really fascinating turn. The very same AI that makes short-term trading a rigged game turns out to be the exact tool that makes this 70-year-old theory more powerful than it has ever been. AI isn't the enemy here. It's the ultimate upgrade. This quote from our source material just says it perfectly. AI is a more powerful engine, not a new map. See, the efficient frontier, that's the map. It represents the timeless, fundamental laws of risk and return. AI is the supercharged engine that lets us navigate that map in real time, using data about what's happening right now and what might happen next. So how does AI become this incredible new engine? Well, it happens in two key ways. First, it creates vastly better forecasts because it's looking at data old models couldn't even dream of. And second, it performs what's called dynamic risk analysis. It can actually see when the fundamental rules of the market are changing in real time. Like, when stocks and bonds, which are supposed to balance each other out, suddenly start falling together. An old model would miss that completely.
And seriously, forget about looking at simple stock charts. We're talking about AI that can read the sentiment of millions of news articles instantly. It can use satellite imagery to count cars in factory parking lots to gauge economic activity. It can track global supply chains and even analyze complex geopolitical signals. It is feeding this old, reliable theory with a rich, forward-looking view of the entire global economy. It's just incredible. Now, this powerful combination of an old theory and this brand new technology, it actually has a name. It's called the Black-Litterman model. It's the professional-grade evolution of this whole idea, originally developed at Goldman Sachs, and now it's getting its own AI supercharge. This table here lays out the evolution perfectly. Just look at the input source row. We're moving from static, backward-looking historical data to dynamic, forward-looking AI forecasts. Now look at risk assumption. We're going from assuming markets will just be normal to actively preparing for those fat tail events, the big market crashes. It's a fundamental shift from a passive buy and hold strategy to a truly dynamic, intelligent system that adapts on the fly.
And you want to know the best part? It actually works. Extensive backtesting has shown that these AI-augmented models don't just beat the old traditional strategies, they consistently outperform major market benchmarks like the S&P 500. This isn't just theory anymore, folks. This is proven performance. Okay, so this all sounds absolutely fantastic for a huge investment bank or a hedge fund, but what about the rest of us, right? Well, the really exciting news is that these institutional-grade tools are rapidly, and I mean rapidly, becoming accessible to everyone. Just look at this number, $800 billion. That is the projected size of the direct indexing market by the end of 2026. This technology, which lets you basically create your own personalized index funds, is one of the key ways these sophisticated models are being delivered to everyday investors. Something that was once reserved for the ultra-wealthy is now a clear sign that powerful personalized investing is going mainstream. And this table shows you exactly how it's happening in the real world. These are examples from Taiwan. You can see platforms like Alpha Robo, Cathay Robo, and Fubon Nano are already using these exact models, from the basic modern portfolio theory all the way to the advanced modified Black-Litterman, to manage portfolios for regular investors. This incredible power is no longer locked away in some ivory tower. So at the end of the day, how do we navigate this crazy, chaotic, unpredictable market? Well, the answer isn't to chase after the chaos. It's to anchor your entire strategy in something permanent, something as reliable as the laws of physics. And this right here is the key takeaway of this whole thing. High-frequency trading, that lives in the weird, unpredictable world of quantum physics. But building real long-term wealth? That's about building a solid, reliable bridge to your financial future. And for that, you need the classic, unshakable laws of Newtonian mechanics. In the world of investing, the efficient frontier is Newtonian mechanics. So in the end, it really all comes down to this one question. The market has changed. The game of speed is absolutely rigged. But a 70-year-old theory, supercharged by modern AI, offers a completely different path, which leaves you with a simple choice. Are you going to keep trying to outrace the algorithms in a game you can't win? Or are you going to build your financial future on the timeless, unshakable laws of risk and return? The choice is yours.